Today's August 16th, and this is the weekly market analysis. Few questions I've been asked. Why did you change your stance recently and turned bullish, abandoning your previous view, calling for one more down leg before the market resumes higher? That was one question. Another question is, why did I take a short position on Friday? Another question is, how high is this current bull market going to go, and will there be a correction anytime soon? So I'm going to try and answer all these questions. First of all, I abandoned my bearish thesis because price told me to do so. If you recall, the correction ended down here. In fact, it ended at a slightly lower low on Thursday, 2 weeks ago. 10 days ago to be exact, 9 or 10 days ago. Prior to that, the bounce following this last down leg that ended on August 1st right here, this down leg that ended on August 1st was retraced by exactly 50%. And then my thesis was that if indeed what's happening now is a counter trend move ahead of the next down leg, it should really stop at the 61.8%, meaning this last down leg, which I labeled wave A of Z, and by the way, I'm discussing the Nasdaq 100 here, right? Don't forget that. So right here, 50% of wave A of Z, and then I expected wave C of Z to be the final leg down and to be just as impulsive as this one, and it should start from either the 50% retracement or the 61.8%. Well, here we took out that 61.8% without hesitation. It's not like we reached it and hesitated for a few bars and then decided to break through. It just broke through it as if it didn't exist. This by itself told me that, hey, this whole thing is over. And that's pretty much where we decided to go long. All right, now, what happened last Friday practically put to rest any doubts I had, because if this were truly wave A of Z and then what ensued is a consolidation, this consolidation would not have, under any circumstance, surpassed the start of wave A of Z. Okay, this is wave A of Z right here. From this point down to here, the ensuing consolidation would not have, under any circumstance, taken out the prior, the high of that wave. So I know for a fact right now, and I would bet anything on it, that it's over. Now there'll be consolidation coming soon, and I'll tell you what to look for. There'll be profit taking as well. So on Friday we reached the prior high, the late July high. The July 24th high was reached, and that by itself catalyzed a profit-taking wave. Now, if you notice here, I counted the wave structure using the harmonic Elliot Wave model, that of Ian Copsey. Okay, it's in Copsey's own variation on the classic model, in which he posits that waves 1, 3, and 5 subdivide internally into 3 subwaves, not 5. And that worked out pretty nicely. ABC was wave 1, 2, and then look at the momentous wave 3. A, B, and C, wave B retraced what? 50% of wave A of 3. Notice here that wave 2 retraced 41.4% of wave 1. Now, it's an obscure retracement level. It's really related to Pythagoras' constant, the square root of 2. But that's besides the point. Anyways, wave 3 ran out of steam at the prior high because, you know, you should look for trades at major pivot highs and lows. That's where the major opportunities lie. And now wave 4, I expected it, and maybe it will still happen. I expected it to come down to at least 38.2%, maybe even 50%. Or why? Because wave B was normal. Wave B of 3 was only 50%. That's borderline. Wave 2 of that retraced only 41.4 of wave 1. That was pretty shallow. According to the alternation guideline, I should expect, it doesn't have to happen because it's a guideline and not a rule, I should expect wave 4 to be deeper. But it only retraced 33% of wave 3, and that's okay. Now, the move on Friday off the low was pretty impulsive, you know, and I feel that one of the reasons, now I'm starting to answer questions, the questions that everyone's asking. The first one being, why did I change my bullish? I switched stances, or I switched stance from bearish to bullish, and I explained that already. Now, why did I take a short position last Friday? Is because I expect wave 4 to subdivide just like waves 1 and 3 into an ABC. So wave A should end somewhere between 78.6 and 88.6%. It could go and retest wave 3, maybe even breach it slightly to the upside before coming down or starting wave B of 5. Now wave B of 5, I expect that. I expect this wave to be deep, meaning it should retrace at least 61.8 to 66.7, maybe even more, 78.6, maybe even 88.6 of wave A. Okay, so I expect some sort of zigzag to form here and get wave C of 5 underway. If you recall, I do have a shark pattern on this. I've published that chart earlier last week. There's a shark pattern right here that has a target of 40.16 or 40.17. Now, does wave 5 have to end right there, 40.16, 40.17? Not necessarily. Okay, not necessarily. It will stop when it needs to stop. So, assuming that what I'm showing you here is indeed what's unfolding. Let me finish this here. Just draw it once and for all. So 40.16, that's the shark. Assuming what I'm drawing is correct, wave 5 will probably end a little higher, somewhere near 40.27 to 40.45, somewhere in that area. Okay? Because how did I calculate this? I assumed that wave 4 is over. And then I took the distance from the starting point of wave 1 to the ending point of wave 3. And then I multiplied that twice, once by 50%, the other by 61.8%. And I projected the results from the end point of wave 4. So really, this distance from the end point of wave 4 up to here is 50% of the total distance measured from the starting point of wave 1 to the ending point of wave 3. Same thing here. The distance from the end point of wave 4 up to this level, 40.45, equals 61.8%, that same total distance from the starting point of wave 1 to the ending point of wave 3. Now, look how nice this is. Assuming that what I'm saying is correct, and we get to 40.16, 40.17, which is the potential reversal zone of the shark, are we going to exceed it a little bit? Probably. Why do I think so? Let's go to the weekly chart. We go to the weekly chart and we recall what happened in late July. Price had been on the rise since mid-May, and as soon as it contacted the top of the yellow channel, it retreated. Now, if next week we once again contact the top of the yellow channel, it'll be around 40.35, 40.37, 40.40, something in that area. Okay, about 10, 15, 20 points above the PRZ of that shark. Sounds good? All right, so we know that a reversal is going to come most likely upon touching the top of the yellow channel, and then we'll have a retracement, and then we'll go on the attack again all the way through the end of the year until we reach, I believe, the top of the channel again, and we complete blue wave 5 and black wave 5 of that 5-wave structure that began how far back? Early June 2012. All right, that's my thesis on this. Therefore, next week, any pullback that we see is an opportunity to get long. And there are a few things I want to talk about. The other question I was asked actually is, how come I'm trading the Qs and not the SPY? Why the QQQ and not the SPY? Well, the answer is simple. Okay, if you look at the relative strength ratios, most notably the QQQ over SPY, look at the outperformance of the QQQ relative to the SPY. This is the relative strength ratio, meaning I'm dividing QQQ by SPY. QQQ divided by SPY, that's the chart. When the numerator is on the rise, or is rising faster than the denominator, what do you get? An uptrend. And look at this, how beautiful this is. It's maintaining, or it's holding above the red trend line, unlike here, when it finally breached it in early March 2014, and then that precipitated the 2 months decline, 2.5 months, March, May, April until mid-May. And then we began a period of outperformance in mid-May, leading to a trend change. Look at the 50 DMA, continues to rise. Okay, so the Qs by far are the best performer, followed by the S&P 500, and the worst of all is, of course, the Russell 2000. And this can actually be demonstrated. Apologies. Let me move this over. This can also be seen using the cloud, the Ichimoku Cloud. I want to show you this next so that you'll understand how to interpret this particular chart style. All right, here is the Ichimoku chart for the Nasdaq 100. Now, this here is the Kumo cloud. Whenever price is above it, that's bullish. Whenever the cloud itself is uptrending, the yellow line and the gray line, this is called Senkou Span A. This is Senkou Span B. And with as long as Senkou Span A is above it, above Senkou Span B, when's the last time we had a crossover? We had that crossover in late June, and that was a good thing, by the way. When the yellow line crosses over, it's bullish. All right. So, and sure enough, price kept rising. But there are other things you have to look for as well. You need the green line to be above the blue line. The green line is called the Tenkan-sen, and the blue line is called the Kijun-sen. And so when you get a crossover, of the green line, when the green line crosses over the blue line, and then they move above the cloud, and price should also move above the cloud, it's an unmistakable signal to go long. Actually, watch this. This was the ultimate signal. Price got out of the cloud. Now, think of it this way. If price is inside the cloud, it's like flying an airplane inside a turbulent area. You want to get below the cloud or above the cloud. Okay, so we moved above the cloud a few days after the crossover. Now the crossover happened below the cloud. When that happens, it's a weak signal. So the crossover below the cloud is a weak signal, and that's why you still saw you kept seeing this consolidation occurring inside the cloud until we broke free. Once price moved above the cloud, and we already had that crossover, so both green and blue were pointing up, were trending up. That was perfect. Now this purple line right here needed also to get above the price bars. Okay, and by the way, this purple line is lagging by 26 days. So when price was here, the purple line was still here. It wasn't really here. Okay, for example, watch here. Price is here, August 15th, but the purple line is lagging by 26 periods. So same thing here. When we crossed over, or we got out of the cloud back in late May, the Chico span, that's what it's called, Chico span, broke out of the cloud and was already above the price bars. So that here was the ultimate signal. That's why you saw this gap, by the way. And when was that? 523. If you go back through my analysis, you will see that weekly analysis number 10 was published on 523. Right there, it was the ultimate moment to go long. Okay, I didn't show that back then, but that was one of the reasons, one of many, many reasons. Go back to that weekly analysis and read it, why I went long. Now look at here. Look what happened here recently. We had a cross under, but the cross under happened above the cloud. When the cross under happens above the cloud, it's a weak signal. Just like when the crossover happens below the cloud, it's a weak signal. Okay, now, if price were to come down below the cloud and the, what is it called? The Tenkan-sen and the Kijun-sen also get below the cloud, it would be an unmistakable sell signal. But here, what we got is support at the cloud. The cloud is rising, and price really tested the July 10th low, not even got there. Okay, so it was a very weak signal not to be taken. All right, and what did we do? We got long a few days ago, somewhere right here, towards the end of the trend. Let's admit it. You know, I missed most of this because my Elliot Wave analysis was telling me to look for another down leg, and you know, I was fixated on that, and that was, of course, one of my flaws. And of course, as long as you recognize what your flaw is, you try and rectify it or avoid it the next time around. So we got long, and then luckily I got out at the high on Friday. Now, this doesn't mean that the market is turning back down from here. However, I did take a small short position, and if it does not materialize into something profitable, I'm going to exit it immediately. And I will explain why I did so in a minute. But let me continue on with the indices. Now that you understand a little bit about the cloud chart, the cloud being the area within these two lines, the Senkou span A and Senkou span B, and the two important lines, the green line called Tenkan-sen and the blue line called Kijun-sen, the purple line called Chico span. So you can really, if you want to learn more about this, you wait for my video, which I'm going to record one about this approach, this Japanese approach to that complements candlestick charts, by the way. Or just search on the web for information. There's plenty of information. That's actually how I learned it. I didn't have to read a book about it. All right, so let me show you something interesting. Let me move over to the Nasdaq Composite. Now, here's what I like about this, all right? What happened is we put in a double top back on July 24th. We actually reached the prior high, which is the July 3rd high, on July 24th. And then we proceeded down. We bounced off the cloud. Again, here we got what? We got a cross under, green line crossed under, but the signal occurred above the cloud. The cloud is getting thicker, by the way, which tells me to expect volatility, more volatility in the in days and weeks ahead. Okay, so now we're about to get a crossover above what? Above the cloud. A crossover above the cloud. Price is above both lines, the green and the blue, and the Chico span. The Chico span is above what? The price bars. Now, if it gets above this double top, it'll be even better. So, from a chart pattern perspective, what do I have? A right-angled descending broadening formation. Okay, now, once I break above this double top, what am I going to get? Confirmation that a breakout, a bullish breakout is underway. What's the measured move? The distance from here to here, and you multiply it by 2. You project it up from this support resistance level, from this horizontal line. What do you get? I get about 46. Actually, on my e-signal chart, I calculated even more accurately, and it turned out to be about 46.49 or so. Now, that is interesting. Hold this. Let's say it's 46.50, roughly speaking, all right? 46.50. Let me move over to my e-signal chart and show you something. All right, so the chart that I want to look at is ComQ, Nasdaq Composite, and I want to look at this chart. Now, you remember back in May, in that same weekly analysis, that I did what? I identified a crab pattern, an unfolding crab pattern. Its PRZ is anywhere from 46.03 to 46.34. Now, if we do get this bullish breakout on this ascending, or I'm sorry, it's a descending right-angled broadening formation. It's a very long name for this formation. It's really a broadening formation of the descending / right-angled variety. So if you measure the distance from the lowest valley in this formation up to the horizontal line, I get about 46.49, 46.50. Now, how close is this to the crab PRZ? Pretty darn close, okay? Now, let's go even further. Let's say, here we go, I messed it up. I managed to place my mouse cursor over the wrong lines and I mess up my charts. All right. Here's what I believe from an Elliot perspective is happening. This AB segment is really wave 1. Then this current run from point C up to the July 3rd high is wave 3. And the August 7th low is wave 4. So 1, 2, 3, 4, 5. Let me use my drawing tool to highlight it in some bright color. So this is a consolidation really here. sideways consolidation that ended on August 7th, and now wave 5 is underway. Okay, let me do this in some other color so that it would stand out. Let's use my bright orange. Here we go. So wave 1, 2, 3, this sideways consolidation, which is the descending right-angled broadening formation, is really wave 4, and this is 5. Now, what is the excuse me, what is the ideal target for wave 5? You take the total distance from the starting point of wave 1 to the ending point of wave 3, and you project that distance from the bottom of wave 4, and you're really not looking for 100% extension. You're looking for the two most common extensions for wave 5, namely the 76.4 and the 61.8. Okay, and I'm going to highlight those in what? Orange as well. All right, what do we get? What do we get, guys? We got 46.55, which is, wow, awful close. And we got even a higher target, which I don't believe we're going to get to. But we're going to get to 46.55. And we're going to get to it and reverse from that area. Why do I believe so? Now let me answer that as well. One more piece in that large puzzle. Remember what I've been citing all along. On the monthly chart, what do we have? We have a large formation that's been in play since the high of 2000. X, A, B, C, D. The B point occurred where? It occurred, if I recall, somewhere between the 38.2% and the 50% retracement of the XA leg. So with point B occurring in between the 38.2 and the 50% retracement levels, this W pattern can only be a bat or a crab. Now, which means this tells me that the bat target of 88.6%, the XA retracement, okay, meaning 88.6% retracement of that XA leg is the target of the bat. Well, where is it? 46.73. How much further up is this target from what I just showed you? Less than 20 points. Look at this. Our target here is 46.34 is for the crab, and 46.55 to, or maybe a little higher, who knows. I could maybe even use the 66.7. These things are not deadly accurate, but here we go. Somewhere around the 61.8%, maybe a little higher, 10, 15 points, will get us what? Where will it get us? It will get us to the bat target. All right, now, therefore, you come to the conclusion that the rally that began at the June 1st low, the rally that began at the June 4th, actually, the first week of June 2012. What is that? Over 2 years ago, right? Yeah, 2 years and 2 months. That rally that's been in place since then will end right here, somewhere. Okay, maybe higher. I don't know, maybe a little higher. But this will certainly generate some sort of downward reaction. It could be the start of a corrective phase. We know that we should remain long until that 88.6% level is challenged, and then we'll start looking for an opportunity to short the market. You see how everything comes nicely together? Now, let's go back to Friday, All right, we know that on Friday, the Nasdaq 100 and the ComQ, by the way, reached the prior highs. Okay, the ComQ fell just short of that. The Nasdaq 100, meaning the tech heavy 100, is actually reached it, fell just short of it, maybe 8 cents or so. Anyways, it reached it, it pulled back. It pulled back to where? To this red line area, the 78.6% retracement of the 2000-2002 crash. Now, some people think that these old levels don't really matter. Well, they do play a role. They do play a role because they played a role previously. They played a role right here. It played a role right here. It played a role here too. We gapped down below it. We tried to test it and continued on lower. And then on last Wednesday, we took it out with force. Okay? We needed force to take it out, believe. And by the way, look at the demarc count. We are on bar number 5 of TD setup. So it's trending beautifully. And, you know, you can't even expect it to start pulling back in profit-taking fashion until 9 bars are completed. And we have one gap after the other. And not only are we on bar number 5, but we are on bar number 5 relative to this dashed red line, which is TD-ST resistance. Okay, this TD-ST resistance line, okay, if we took it out on the way up early on in the TD setup series, this portends strength. Okay, so we have 5 more sessions or 4 more sessions, Monday through Thursday, so to complete a 9-bar series. So I expect next week to be very bullish, and I hope it starts out with a pullback because the rest of it will be nothing but upside. Now, here's the other thing you need to look at. So not only was it the fact that the Nasdaq reached the prior high that precipitated Friday's profit taking, but it's also the Russell. The Russell is the weakest of all the indices. What did it do? It reached this upper line, the line connecting this high, this pivot high, this pivot high. Draw it down like this, and you see that price reached it on Friday. Now, if you recall, this decline from the high, from the when was it? The July 1st high, set the stage for a 5-wave decline. And I'm going to highlight this in yellow as well. Here we go. So from the July high, we got a 5-wave decline. 1, 2, 3, 4, and 5. And then we got this very tepid bounce. We get this tepid bounce that didn't even get to the top of wave 4 of the prior 5-wave impulse. But then what we got is the weirdest thing, because from here I would expect another 5-wave move to get underway. We didn't get it. We didn't get it. Okay? We did not get it. And now that we've reached the top of this line, that presented me with another reason to go short on Friday. It constituted the other reason. Meaning, either something unexpected is going to happen that's going to cause the Russell to come down and touch this broadening formation for the third and final time before it turns up, or I'm going to accept what's happened, and what we saw here is nothing but a normal pullback ahead of the breakout. Because anytime you reach a line like this, you're going to pull back a little bit. You see profit taking, and then you need to see demand overwhelming supply to break through this line. Now, if this is a broadening formation, a descending, broadening wedge, the target is what? The starting point of the wedge right here, 1169.55. Okay, that's the starting point of the wedge. Now, Others are going to see it differently. They're going to see an inverse head and shoulders forming because last Friday's low coincided with this swing low right here. The swing low of July 17th, which was 1131. What was the low last Friday? 1131. So now if we break above it, okay, let's say something like this happens next week. Let me use this tool. Something like this. And then we break above this line. We know immediately to go long with target of 1169.55. If we get above it, of course we're going to 61.8% retracement. And above that practically gives us a target of what? The 88.6% retracement. The measured move of this HS will be the 88.6% retracement. Now here's the interesting thing. Will the Russell by then have put in, will it put in by then a lower high while the Nasdaq is establishing a new all-time high? Okay, that is a big question. In other words, once the Nasdaq indices reach our targets, we know what those are. Will the Russell by then make a new high or will it be a lower high? The reason why I'm so concerned about this is because I see a lot of disconcerting disparities forming in the market, similar to the few months that precipitated the summer 2011 swoon. And I'm going to talk about this here as well. Before I move on and start talking about these concerns, discussing them, I want to talk about the S&P 500. The S&P 500 never got the chance to fill any of these gaps. Quite amazing. Okay, if we look at the Ichimoku Cloud for the S&P, look what happened. We came down to the bottom of the cloud, okay, Senku span B, but the cloud is still rising. So there was no reason to be uber bearish. Now we did get the crossover. Where did the crossover occur? It occurred above the cloud in bullish territory. Above the cloud is bullish territory. Below the cloud is bearish territory. Inside the cloud is neutral territory. It's turbulence. You know, when price is inside the cloud, you really don't want to trade it until it breaks out of the cloud. Now, look why. Here's the reason why the cloud chart of the S&P is so much worse than the Nasdaq. In the case of the Nasdaq 100, everything is above the cloud. Tenkan-sen, the green line, the Kijun-sen, the blue line, the Chiku span, the purple line is above the price bars, and the price is above everything. So this is a picture perfect, and we're about to get this crossover, by the way. This is a picture perfect opportunity to be long. All right, to be long. Now, here, look at this. The purple line, which is the Chiku span, is above this, below this consolidation area. The fact that we're back at this consolidation area from a month ago tells me that price is still swimming in mud. And sure enough, it tried to get above the cloud, couldn't last Friday. Here's the other thing. The Tenkan-sen, the green line, is still below the Kijun-sen, the blue line. It is pointing up, of course, and eventually we will, or we might, let's say, we're likely to get a crossover. And I want to see both lines above the cloud, and I'd like to see price above that same cloud as well. I'd like to see the Chiku span above this consolidation. So the S&P right now is the weaker of the two. Okay, compared to the Nasdaq, it's visibly weaker until we see a break above the cloud and see the Chiku span above the price bars anywhere in the open. All right, and then see it cross over. I would say that we might see some consolidation in a couple of days, in the next day or two on the S&P 500. That's the other reason why I took a short position. It's going to be a very short-lived short position. It might last a day or two at the max. All right, so this guy needs to improve its situation to catch up to the Nasdaq 100. Now, if you do look at the E-signal chart here, I said 2 days ago that on Wednesday's session confirmed the NR4 pattern. NR4 pattern are the bars, these bars from Tuesday, Monday, Friday, Thursday. All right, and I wish I had the numbers still on. These are the bars I'm talking about. 4 bars inside this gray box. That was Thursday of 2 weeks ago, Friday, Monday, and Tuesday of last week. If you look at them, you will see that last Tuesday's bar is the smallest body of all the 4, has the smallest body of all 4 candles. This is what the NR4, the narrow range 4-bar formation, is about. So this basically tells us that if price breaks above this range, meaning the lowest low to the highest high in this 4-bar formation, then it confirms the NR4 breakout and gives us a target of 1985. 1985. That's interesting. Why? Okay, so we took this distance from the lowest low to the highest high in this 4-candle formation, and we got 1985. What is 1985? It is TDST resistance. TDST resistance is what, really? It's the highest high in the last TD setup series that we saw. So that was the high of July 24th, and we started trending down according to DMARC. The DMARC count is performed as such. You look at the closing price of this bar relative to the closing price of 4 bars ago, and if it is lower, you get a bearish price flip. If you get 9 consecutive bars whereby each closing price is lower than the closing price 4 bars earlier, then this is called TD buy setup. We certainly did get 9. We got 9 just above this support area, the open gap. And this saw buyers step in, driving prices higher like we saw here. Okay, so now we are on bar number 5 of what? TD sell setup. Monday, Tuesday, Wednesday, Thursday. I think by Thursday, the S&P 500 will be at 1985. That's a lot of points from here. That's 30 points from Friday's close. Okay, so now imagine how many points this will equate to on, say, the Nasdaq side, taking into consideration the Nasdaq is actually outperforming. So by then, the Nasdaq will probably have reached its upside target. The S&P will have reached 1985, and from there we'll possibly see what? A profit-taking pullback. A profit-taking pullback. If from here down to here we got an 88.6% retracement, we could pull back to form what? A W pattern on the way higher. Now, if I take the the last down leg right here, and I extended by 1.618%, I get how far up? 2044. So we could reach 2044 by the end of the year. Keep that in mind, 2044. All right, maybe even higher. I have a chart calling for higher, but we'll see. So you understand why I'm bullish, right? I'm putting it all together here, and what do I get? I get a bullish bias. I can only be bullish at this point, given the various divergences and the concerns that I'm going to voice in the coming few minutes. Now let me before I move on over to that, let's look at the Russell 2000, the cloud chart of the Russell 2000. This is one ugly POC. All right, look at this. The Chico span is inside the cloud, and the future cloud has what is called a TK cross, meaning the I'm sorry, that's right. The Senko A crossed under the Senko B, meaning the yellow line is below the gray line. This is bad. This is telling you to expect something bad in the future, or right now things are bad. The future cloud is not bullish. Okay, that's a this is 26 days from now. Now look at this. Price can't even get inside the cloud. It's still in bearish territory. Okay, the Russell is still in bearish territory. There is no crossover. And even if we did get a crossover, it will be in the bearish territory, meaning it would be a weak signal. Again, Chico span is inside the cloud and below price. This is a very bearish picture. Something has to happen to help this sucker back up to the top of this formation. So that is another reason why I took a short position, because if something happens over the weekend and I'm wrong and we're going to get, price is going to turn back down immediately from here towards the lower trend line, then I'll be ready. But I do expect this to result in an upward breakout up to here, up to 1169. And then if we're truly going as high as the alleged inverse head and shoulders, we will go up to, what did I say? The 88.6% retracement. How much is that? Let me mark it. 1201. So we'll retest the prior high. Now there is a little bit of a shark pattern here, but it's sort of violated the downside limit, but it violated it and then closed above that limit, so it was rejected. If we do by any chance make a new high, it will probably be, if we make a new high, it's a big if, all right, big if, it will be as high as 1228. Okay, 1228. Now if you take the extension of the AB line, Fibonacci extension of this segment here, and we're looking for what? I'm sorry. We're looking for 2.236. 236, we do have the possibility of a shark right here, 1228, 1230, just above the July 1st high. So I expect this, and that's how I'm going to trade it. If we get above the wedge, the immediate target is the inception point of the wedge, 1169. We get above that, we're headed up to the 88.6%, knowing full well that the cloud itself is going to be resistance. It's going to pose as resistance on the way up. And notice that the cloud sort of coincides with this open gap right here. These are points to keep an eye on. This fill here, this gap fill, the closing price was 1173.81, coincides with the Senku span A, meaning the yellow line of the cloud, the yellow line containing the cloud. All right, so keep in mind this is going to be resistance. But once we break free, we get above it. Hopefully by then, the Chiku span will be above price as well, out of the cloud and above price. It will actually, okay? Because really, if you haven't noticed yet, the purple line is exactly what price is doing right now, but it's shifted back. Okay? It's same thing, exactly what price is doing, but shifted back 26 days. All right, so if in the next few days price reaches here, this level, the eventually we're gonna see this line getting as high as here, and it'll be in the open, ready to break out and get to 1201 first. And if we take out the prior high, we're going to get to 1228 to 1230. Keep that in mind. Now, longer term. So we've already established that right now I am bullish for the next few weeks. Let me take a little break. Let me resume in a minute or so.